All right, let's jump right in. We're going to take one of those super dense, jargon-filled corporate filings and break it down into a story that actually makes sense. And today, we're looking at a recent announcement from Signpost India. Let's see what it's really telling us.
Yeah, I know the feeling. You see a document that looks like this, a wall of text, a fancy letterhead, all this legal language, and your eyes just glaze over. It feels like it was designed to be ignored by regular people. And honestly, most of us just scroll right on by.
But what if this isn't just a boring legal document? What if it's actually more like a treasure map? A map that's telling you a really important story about a company's health, where it's headed, and who's calling the shots. You just need to know how to read the clues. And that's exactly what we're going to do together. We'll break this down into 5 easy steps. First, we'll decode what the announcement even is. Then, we'll do a quick financial health check. We'll look at the people behind the numbers, read the all-important fine print, and then pull it all together to see what it really means.
So what is this thing anyway? Well, it's an official notice that Signpost India has to send to the stock exchanges like the BSE and NSE. See, companies that are publicly traded are required by law to file these things to report on how they're doing and to announce any big decisions. You can think of it as their mandatory progress report to the public.
Okay, now for the good stuff. The first place you always look in one of these filings is the numbers. This is the company's report card. It tells you straight up how they're actually performing. First up, total income. In the third quarter, Signpost India brought in about 14,352 lakhs. Now, since a lakh is 100,000 rupees, we're talking about a pretty significant amount of money coming through the door. This is what's called the top line. It's all the cash they generated before any costs are taken out. But of course, you have to spend money to make money, right? So their total expenses for that same period came out to around 11,852 lakhs. This is everything. We're talking salaries, services, operating costs, the whole shebang. So here's the million-dollar question, or in this case, the 1,814 lakhs question. What's actually left over? Once you take the income, subtract all those expenses, and pay your taxes, you get the profit. This is the bottom line, and it's the number that truly tells you if a company is healthy. And for them, it's a very solid 1,814 lakhs.
But here's where it gets really interesting. A number on its own doesn't mean much. You need context. So look at this. Their profit this quarter is more than triple what it was during the same time last year. That's not just a little bit of growth, that's a huge jump, and it sends a really powerful positive signal. Great numbers are one thing, but they don't just appear out of thin air. So now we need to shift from the what to the who. Who are the people responsible for this performance, and are they making sure everything is being run correctly?
And right away, this filing gives us a major clue. The company's board just approved a brand new appointment. Ms. Kinjal Mistry is now the company's secretary and compliance officer. And trust me, this is a really big deal. So, who is she? Well, the filing tells us she's got over 15 years of experience, a background in both commerce and law, and she's worked at huge companies like Tata Motors and SR Oil. Let's just say this is not her first rodeo. She is a serious, seasoned professional. So why does her appointment matter so much? Well, the company secretary is basically the company's chief referee. Their whole job is to make sure the company is following all the complicated rules and regulations. Hiring someone with her kind of background? Well, that signals that the company is very serious about playing by the book. And that focus on strong governance doesn't stop there. The document also mentions that they're reappointing their internal auditor. These are the folks who are constantly checking the company's processes from the inside out, making sure everything's running the way it should be. So, we've looked at the numbers, and they're strong. We've looked at the people, and they're bringing in experienced leaders. There's just one last check we have to do, and it's a crucial one. What does a totally independent, outside expert think about all this? This is where the auditor's report comes in. And here it is, the final verdict. I know, it's a mouthful, but when an auditor says, "Nothing has come to our attention that causes us to believe there's any material misstatement," that's just fancy auditor talk for, "We checked their work and everything looks good to us." This is what's called a clean opinion, and it's the gold star you always want to see. So you basically have two layers of accountability here. First, the company's own chief financial officer signs off on the numbers. Then, an independent auditor comes in, reviews everything, and signs off on it too. It's a fantastic system of checks and balances. Okay, let's take a step back. We've dug through the numbers, the people, and the fine print. We've learned a ton about Signpost India for sure. But more importantly, you've just picked up a simple, powerful framework you can use to read any of these corporate filings. So the story this one document tells us about Signpost India, it's a pretty good one. They're seeing fantastic profit growth. They've put a new, very experienced leader in charge of compliance, and they got a clean bill of health from their independent auditors. All green flags. And this right here is your new superpower. The next time one of these documents crosses your screen, don't just scroll past. You now have a simple 3-step guide. Number 1, find the profit and see if it's growing. Number 2, check for any big changes in leadership. And number 3, hunt for that independent auditor's opinion. That's it. That's your shortcut to the heart of the story. So there you have it. What looked like a wall of confusing jargon just a few minutes ago is now a story you know how to read. You've officially cracked the code. The only question is, what story are you going to discover next?
You know, usually when we start one of these deep dives, I'm sitting here with this precarious stack of articles.
The mountain of paper.
A mountain of paper, exactly. Maybe a hardcover book or two, a couple of printed PDFs, and, the drill.
Right, and my job is usually to help you dig through that mountain and, find the important stuff.
Exactly. But today is, well, it's weirdly different. Today, our source material isn't a library.
Yeah.
It's a single image, just one file.
But what an image it is. I mean, as the saying goes, a picture's worth 1,000 words.
Or in this case, maybe thousands of dollars if you can read the tea leaves, right?
Potentially.
Right.
Yeah.
So for everyone listening, I want you to visualize this with us. We aren't looking at text.
No.
We're looking at a snapshot of financial data, specifically a stock chart for a company called Signpost on the NSE.
And we're looking at it right now, today, February 9th, 2026.
And this isn't just a bunch of random lines on a grid.
Oh, not at all. This is a narrative. It's really a map of human psychology, greed, fear, panic, and right now,
What's the feeling right now?
extreme indecision.
Yeah.
All played out over the last 2 years.
So that's our mission today then. We are going to decode this visual story. We're not just reading numbers.
We're trying to understand the journey.
Yeah, we're going to figure out how Signpost got from point A to point B and why looking at this specific chart right now makes the hair on the back of your neck stand up a little bit.
Well, my neck, certainly. It's a classic technical setup that, it makes analysts very nervous and also very excited at the same time.
Okay, so let's orient everyone first. If you're imagining a stock chart, you probably just see a jagged line going up and down. But we've got a bit more detail here, right?
You do. The source is a chart from the Nuvama trading platform, and it's set to a weekly time frame.
And that's important. The weekly part.
It's a crucial piece of context, yeah.
Okay, so why is that crucial? Why not look at the daily chart?
Because the daily chart is just full of noise. It reacts to rumors, to, bad weather, to a CEO sneezing.
Right.
The weekly chart filters all that out. Each little bar or candle on this chart represents an entire week of trading.
Monday open to Friday close.
Exactly. It shows you the conviction of the market, not just the mood swings.
So this is the macro view, the big picture.
Precisely. And overlaid on the price, we have some specific technical indicators.
I see those. You see those green lines flowing around the price like a river?
Those are Bollinger Bands, and there's a red line snaking through the middle.
Okay, what's that one?
That's the moving average. And then down at the bottom, we have the engine room,
The engine room, I like that.
the RSI, or Relative Strength Index, and the volume bars.
And we are going to unpack all of those fancy terms, I promise. But let's ground everyone in the now.
Okay.
We're recording this on February 9, 2026. The chart gives us the hard numbers for this current week.
Right. Let's look at the stats. Signpost opened this week at 209.00.
209. Okay.
It pushed up as high as 213.00, dropped as low as 205.00. And right now, the closing price sits at 210.54.
210.54. Okay, so you just tuned in and heard 210.54, and that the range was between 205 and 213. You'd think, so what?
Who cares?
That's an 8 rupee range. It's barely moving.
It looks quiet. It looks incredibly boring.
But the path to get to this quiet little 210 has been an absolute roller coaster. I'm looking at the left side of this chart back in early 2024, and wow.
It's a dramatic difference, isn't it?
It's like looking at photos of a rock star before they went to rehab. It's huge. Visually, the price was way up at the top of the screen. I'm just eyeballing the axis here, but it looks like it was trading, what, around the 410 mark?
Yes, looking at the peak in early 2024, it was clearly testing that 410 to 415 level.
That was the good times.
That was the era of maximum optimism. Everyone thought Signpost was going to the moon.
So we're talking about a stock that has, essentially been cut in half over 2 years.
Pretty much. From the 400s down to the 200s.
And looking at the shape of that drop in 2024, that wasn't a gentle slide.
Oh no, you see those long red candles. That was a steep, jagged decline.
Right.
That represents panic.
People getting out. Fast!
Investors who bought at the top were seeing their value just evaporate week after week.
It's the classic catching a falling knife scenario.
Exactly. And then it finally hits a bottom, mid-2024.
Yeah, it looks like it found a floor there. It kind of bounced around in that 200 to 250 range for a while.
This is what we call consolidation or base building. The sellers were exhausted. They'd sold everything they could.
And the buyers started to dip their toes back in.
They started stepping in thinking, okay, surely it can't go lower than this.
But the story doesn't end there. This is the part that gets me. Look at late 2024 into early 2025.
The recovery rally. Yeah,
There's this massive mountain in the middle of the chart. It climbed all the way back up.
it really did.
It looks like it was challenging the 350, maybe even 3 heady levels right around the turn of the year into 2025.
That's the hope phase. You see the price crossing above that red moving average line. That usually signals a change in trend.
So everyone gets excited again.
Everyone probably thought Signpost is back. We survived the crash. New highs, here we come.
But spoiler alert, we didn't stay there.
No, and that is the tragedy of this specific chart. That 2025 peak was a lower high.
A lower high. Okay, why is that term so important?
Because in technical analysis, a healthy trend makes higher highs. If you peak at 410, you crash, and then your rally only gets to 380 and stops.
It tells you something.
It confirms the long-term trend is still down. The bulls ran out of ammo before they could break the old record.
And since then, since that failure in 2025.
It's just been a slow, grinding descent.
It's agonizing to look at. It's not even a crash, really. It's just a slide.
It's just dripping lower and lower and lower.
Until we get back to where we are today.
Exactly.
No.
It's a complete round trip. We went from the 200s up to nearly 400 and all the way back down to 210.
So psychologically, what does that do to the market? If I'm an investor holding this, how do I feel?
You feel exhausted.
Yeah,
It creates a lot of confusion and a lot of what we call bag holders.
the people who are stuck.
People who bought during that rally in 2025 because they thought it was recovering and are now sitting on losses. But more importantly, it leads to the state we're in right now.
Which is?
Indecision. The buyers failed to keep it up. The sellers failed to push to zero. So everyone is just staring at each other.
Which brings us to the squeeze.
Yes. This is where it gets fascinating. This is the aha moment for the chart readers.
Okay, let's talk about those green lines. The Bollinger Bands. I love the name, by the way. Sounds like a 1920s jazz orchestra.
It does have that ring to it.
And now, putting on the Ritz, the Bollinger Bands.
But in technical analysis, they are absolutely critical. Think of them as an elastic envelope around the price.
Okay.
The top green line is the upper limit of where the price should statistically go, and the bottom green line is the lower limit.
And usually, looking at 2024 and 2025, those lines are pretty far apart. It's a wide river.
Right. When the bands are wide, it means volatility is high. The price is swinging wildly. Big ups, big downs.
So the bands expand to contain it.
They expand to accommodate that movement. But look at the right side of the chart. Look at 2026. Look at today.
It's completely different. They're pinching.
They are.
The top line and the bottom line have come almost together. It looks like a snake that swallowed something and is being squeezed tight.
That is the Bollinger Squeeze.
Yeah.
And it is one of the most reliable signals in charting.
What is it signaling?
It signals that volatility has been crushed. The price is trading in such a narrow range.
Yeah.
Remember, this week we're only between 205 and 213 that the bands have contracted.
So it's boring. It's dead.
It's deceptively boring. In the market, periods of low volatility are almost always followed by periods of high volatility.
Always.
Almost always. Markets breathe. They inhale and exhale. Right now, Signpost is holding its breath.
So when you see a squeeze like this, you know something big is about to happen.
You know a move is coming. You don't necessarily know the direction just from the squeeze itself, but you know the magnitude will likely be significant.
It's compressing energy.
Exactly. And where is the price sitting relative to that red line, the moving average?
It's weaving right through it. Look closely at the last few candles on the far right. The price is hovering right around it.
And maybe slightly below it. It's clinging to it.
It's like it's walking a tightrope.
Precisely. It's lacking a clear trend direction at this exact moment. It's not decisively bullish or decisively bearish. It's just existing.
It's waiting for a signal.
It is.
Okay, let's look under the hood then. We've got the price chart idling in the driveway. Let's check the engine.
The relative strength index, the RSI.
Yes, the RSI graph at the bottom, it says RSI 14, and the line is just sort of floating.
It's not at the top, not at the bottom.
Visually, it looks like it's around the 40 or 45 mark.
That's a fair estimate.
Yeah.
The RSI goes from 0 to 100. If it's above 70, the stock is overbought.
Too expensive, due for a drop.
Yeah, if it's below 30, it's oversold, maybe a bargain.
And at 45?
At 45, it is in no man's land. It's neutral. It mirrors the price action perfectly. The momentum indicators are telling us neither the bulls nor the bears are in charge.
It's a demilitarized zone.
A perfect description.
No man's land. That feels very appropriate. But there is one thing on this chart that isn't a flat line.
Uh-huh.
And I think this is the weirdest part of the whole image.
You're looking at the volume.
The volume. Okay, look at the very bottom. You have these little bars representing how many shares are traded. Most of them are small, consistent little spikes.
Mm-hmm.
But then, back in mid-2025, there's this outlier.
The big one.
There is one solitary, massive green spike. It's like a skyscraper in a neighborhood of bungalows. It is huge.
That is a very significant anomaly.
What happened there?
Well, without any external news, we can only read the chart. That spike represents a massive influx of buying interest.
A lot of money changed hands.
A huge amount of money changed hands right there.
But look where the price was when that happened. It was sliding down from the peak, right?
Yes. It was during the decline. This is often what we call a buying climax, or sometimes a trap.
A trap.
A lot of people, maybe institutions, maybe retail crowds, reading a forum, post, stepped in and bought aggressively thinking the dip was over.
They threw everything they had at it.
And what happened after that skyscraper of volume?
The price kept falling. Ouch. That hurts just to hear.
That is the critical insight. That momentum wasn't sustained. All that energy, all that money.
And the price just drifted back down to where we are now, at 210.
Yep. So all those people who bought during that giant green spike,
they're not happy.
they are likely underwater. They're holding shares that are worth less now than when they bought them. And that creates overhead resistance.
Okay, explain that concept. Overhead resistance.
Imagine you bought at 250 during that spike. Now the price is 210. You're miserable. You just want your money back.
Okay.
If the price ever climbs back up to 250, what are you going to do?
I'm going to sell. I'm going to break even and run for the hills.
Exactly. And when you sell, you push the price back down. That huge volume spike represents a ghost army of sellers waiting above us.
Making it hard for the price to rise. And what's the volume doing now in 2026?
It's dried up. Look at the far right of the volume bars. They are tiny.
So the crowd has left the building.
Essentially, yes.
Yeah.
The tourists have gone home. The speculators got burned and left. Now you're left with the diehards and the algorithms.
And the lack of volume confirms the lack of volatility.
It does. Everyone is just waiting.
It's funny, isn't it? We usually think of the stock market as this noisy, shouting place.
Right.
Like scenes from a movie where everyone is yelling, buy, sell. But looking at this chart for Signpost specifically this week, it feels like a ghost town.
It does. But I prefer to think of it as a library. Silence is required for concentration. Or perhaps more accurately, it's the silence of a predator right before it strikes.
Oh, I like that better. That fits the data.
It does.
So let's try to synthesize this. We've got the learner listening. They want the aha moment. How do we connect these dots?
Let's review the evidence. One, price is flat. We have these little doji candles, basically crosses where the open and close are almost the same, total indecision.
Yuck.
Two, volatility is crushed. The Bollinger Squeeze is as tight as it has been in 2 years.
Yuck.
3, momentum is neutral. The RSI is asleep at the wheel, hovering at 45.
Check.
And 4, volume is low. No one is shouting.
So is the stock dead? Is Signpost just done?
Absolutely not. This is the most dangerous and exciting setup in technical analysis.
Why? If nothing is happening, why is it exciting?
I want you to imagine a coil spring. like in a mattress or inside a clickable pen.
Okay, got it. I'm picturing it.
If you leave the spring alone on a table, it takes up space. It's relaxed. But if you press down on it, you compress it.
You squeeze it.
It gets smaller and smaller. It looks like it's not doing anything. It's quiet.
But it's full of energy.
Exactly. It is resisting the compression.
Yeah.
The tighter you squeeze that spring, the more violent the reaction will be when you finally let go.
That's the Bollinger Squeeze.
That is the Bollinger Squeeze. Signpost isn't dead. It is a coiled spring. The market is compressing energy into this tiny 205 to 213 range.
And the fact that the current candle, this week's candle, is so small
Is the final turn of the screw. Open 209, close 210.54. A movement of 1.5 points on a stock that used to move 50 points in a week.
That can't last.
That standoff between buyers and sellers is unsustainable. It defies the laws of market physics to stay this quiet for long. Someone has to blink.
Someone has to blink. I love that. It's a staring contest.
And when someone blinks, when the price breaks out of this tight green envelope, it usually triggers a cascade.
Explain the cascade.
If it breaks up, say it closes nicely above 213 and volume rushes in, everyone who is waiting on the sidelines thinks the train is leaving, and they rush in to buy.
The price explodes up.
And if it breaks down,
Below 205.
then the floor falls out. The people holding on for hope give up. They panic sell. And the energy releases downward, probably retesting the 2024 lows.
So for our listener, for the learner, the lesson here isn't just about signposts. It's about recognizing this pattern.
Yes. Don't chase the noise. Don't chase the giant green spikes after they happen. That's how you become a bag holder.
You look for the quiet.
Look for the quiet. Look for the squeeze. That's where the potential energy is stored. That's where the opportunity is born.
That is such a cool way to look at it. We started this deep dive thinking about a boring, flat chart, and now I feel like I'm watching a bomb squad defusing a device.
Let's hope it's a controlled explosion for the sake of the investors.
Seriously. So let's wrap this up. We've been on a journey with Signpost today.
Yeah?
We saw the glory days of early 2024 trading up at 410. We felt the pain of the crash down to the 200.
We analyzed the false hope of the 2025 rally.
And the slow slide back to reality. And now, here we are, February 9, 2026. The stock is hibernating.
Consolidating.
Consolidating. It sounds much more professional. But why does this matter? Why did we spend all this time on one chart?
Because this is a perfect case study in market phases. Markets are not linear. They cycle, they run, and they rest.
And most people only pay attention during the run?
The volatility, the news headlines, the tweets, the
Or-
FOMO.
FOMO.
But the rest, the consolidation, the squeeze, that is where the next move is actually constructed.
Here.
If you want to understand the market, you have to learn to respect the quiet times
I think that's a great takeaway. It's about patience.
and observation. You don't need to trade every day. Sometimes the best trade is to sit on your hands and watch the bands tighten.
All right, before we sign off, I know you always have one last thing stewing in your brain, one final thought for us to chew on.
I do. It's a question of physics again, really. We talked about the spring, we talked about energy.
Right.
In financial markets, just like in physics, energy is never destroyed. It is only stored.
And right now.
We are looking at a chart of Signpost, where the Bollinger Bands are tighter than they have been in 2 years. The energy storage is at maximum capacity.
Joe!
So the question isn't if the silence will break. We know it will. The question, and this is what keeps analysts up at night, is simply this. When those bands finally rip open and all that stored energy is released, which direction will the explosion go? Because gravity pulls down, but hope pulls up.
And right now.
Right now, they're perfectly balanced.
And on that cliffhanger.
I will leave you to stare at the chart. Thanks for diving deep with us today.
Happy analyzing.